In this lecture, I'm going to discuss how commercial banks create money. First, I want to dispel a common misperception. That misperception is based upon an understanding that loans are made with pre-existing funds. For example, funds that savers may deposit in a bank. This is called the loanable funds model, and it is completely false. New money is only created when a bank makes a loan. And this loan is not based on any pre-existing physical resource. When a bank makes a loan, it electronically records a new deposit and the name of the borrower. And at that moment, new funds are created. And these new funds will stay within the banking sector until the loan is repaid. There's a very simple illustration. Let's assume that a household wants to purchase real property. So the household approaches the bank agrees to extend the loan, of course, with many conditions. And what does the bank do? The bank does not give the household currency. The bank does not transfer already existing funds that it may have received in the form of savings. No, it simply electronically creates a new deposit in the name of the borrower and in the amount of the loan. Those funds then are ordinarily withdrawn and used for particular purposes, and those funds will remain in the banking system until the loan is repaid. I provide a simple illustration of a bank's assets and liabilities prior to a loan and a bank's assets and liabilities after a loan. It's very self-explanatory. There are other ways for the banking sector to create funds or new money. And that is by buying from the non-bank private sector financial instruments. Why does this create new money? Well, it's obvious. When the bank buys, it has to pay. And what does it do? The sellers are credited with new electronic deposits, and thereby money is created. Vice versa, when the bank sells financial instruments, and these financial instruments are generally highly liquid, government bonds and other debt and equity instruments that are highly convertible to cash, it destroys the money. Now, there are constraints on the system, and this explanation is very oversimplified, but there are market constraints. So, for example, one must take into account market forces, competition, mitigation of risk, evaluation of the borrower's ability to repay, evaluation of the value of collateral, and so on. And there are also regulatory policies that must be followed. Another constraint is simply the behavior of households and companies. Their behavior may change the ecosystem for new funding or a contraction. And third, and probably the most important, is the central bank monetary policy. And that is simply setting the price of money, the price of reserves. And this is a key factor, setting of interest rates, to constrain or stimulate the creation of new money. Now, we've all seen financial cycles, the booms and the busts, and this is a problem. There are periods of irrational enthusiasm, as Greenspan might say, when all banks in a particular market decide that they want to lend. Now, if these loans are not provided to support economic activity, they lead to asset inflation. The typical example is a hot market in real estate. So banks are competing against one another furiously for new customers. And what are they essentially doing? Well, they drive up the value of the asset in question. In my example, it's real estate. And at some point, the asset's value becomes unsustainable. And when that point is reached, then the process collapses. The bubble bursts, assets are reevaluated. Often it can be beneath the amount of the outstanding loan, and this can lead to bank failures. So in conclusion, banks create new money when they lend. New funds are produced only with new bank loans. The quantity of money in the system is increased. Saving does not finance investment. It is financing and money creation that do this. Repayment of outstanding loans destroys money, and we have seen that money can also be destroyed by selling, by the issuance of long-term debt and equity instruments. I've also provided a short list of sources that you may want to review on your own. Thank you.